Markets bet on a September rate cut. Vice President Harris wins a key endorsement, and the Paris Olympic Games begin after a rail sabotage. This is Bloomberg Wall Street Week. I'm Romaine Bostick in for David Weston. And we begin with the week in markets. It saw a rotation out of big tech and into small caps. When you take a look at an S&P 500 that rallied here on this Friday afternoon, but still ended the week in the red, you have to overlay that with the massive outperformance that we saw in the small and mid cap space. 4 straight weeks now where we've seen the Russell 2000 outperform the NASDAQ, outperform the Mag 7, outperform the broader market overall. And a lot of that seems to be predicated on the belief that interest rates might be coming down soon. Peter Borish joining us right now, the chairman and CEO of Computer Trading, to talk a little bit about some of the moves that we saw this week. And Peter, some of this does seem to be driven by the macro, whether it was the economic data or maybe the feed through into what folks think that macroeconomic data is going to mean for the Fed.
Absolutely. But it could also go back to rule number 1 that we all learned: buy low, sell high. This market has been one where everybody's been buying high. And so what did we have? We had a natural rotation to oversold stocks, out of stocks that were highly overbought. Now, the question is, has the underlying fundamentals changed? To me, they have. As you know, the last time I was on here, we talked about the 7 C's of all the commodities. That market in general has been much weaker. Grains, crude oil, cotton, copper in particular. So that may be an indication that the Fed is more likely to ease, and therefore the small cap stocks benefit significantly in a interest rate environment where rates are going down or more stable.
They would benefit from rates going down, but if economic conditions are weakening to the point where the Fed thinks it needs to cut rates, how is that going to benefit small caps?
Great question. Yeah. So that also gets into the yield curve and interest rates and whether the Fed cuts, are longer rates going to go up? Is it going to be a bear steepener? But the first reaction is mean reversion. So that's buying things that were oversold and selling things that were overbought. There could be this week, and part of it could be the fact that Vice President Harris has done significantly better in the polling, and that may imply the expiration of the Trump tax cuts, which could lead to higher capital gains rates, which could lead to selling winners again and harvesting some of your losses, which were in the small cap. So a lot of positive things have come together for that.
It's interesting you raise that point here about people basically buying effectively the laggards. I mean, I was looking at one stock today on this Friday, Newell Brands, of course, makes all those little Rubbermaid things that you have in your cabinet. It's up more than 30% on the day. But then when you look at its performance prior today on a year-to-date basis, of course, it was also down double digits here. So people are definitely looking at the bottom of the barrel and maybe finding some hope there. But it gets back to the question about economic conditions, consumer spending. And we had a PCE report on Friday. You had a GDP report a couple days ago that, while still healthy, certainly showed some softening when it comes to the consumer.
No question about it. And what I look at for the strength of the consumer is I look at Visa, I look at MasterCard. And those stocks have been underperforming, let's say, relative to American Express, where American Express tends to be the card of choice for higher income holders. So the economy seems to be slowing. You've also seen that with the rate of growth in employment. Unemployment claims are higher. Wage growth has stabilized. So a lot of pieces of the puzzle are getting a little bit clearer here as we go into, you know, the quiet period of August, which is also a market volatile period, to indicate that things are slowing down.
It's interesting when we look at some of the market moves over the last, 5 or 6 weeks. I mean, you've obviously seen a bid come into some of those economically sensitive areas like utilities, like materials. Probably one of the more interesting stealth rallies out there, and stealth to me at least, was some of the moves that you saw in banks over the last couple of weeks, and not just the big banks. We're talking about some of those regional banks that everybody sold off about a year and a half ago.
Yes, so who's going to be the biggest beneficiary of those cut in interest rates is going to be the regional banks. And over the last 3 weeks, they have really outperformed the Goldman Sachs's, JP Morgan's of the world. It's been, to me, that's been more impressive than the rally in the small cap IWM.
And do you think that rally can continue? Do you think there's enough there in terms of fundamentals to support it?
If the economy stabilizes, absolutely. If we're seeing something that's the economy slowing much more rapidly than the consensus is, or that I think, then no, they'll sell off again. But that is not the feeling that I have or many economists have.
All right, Peter, always a great conversation. One of the best in the business. Peter Borish of Computer Trading Company, right here on Wall Street Week. When we come back, a closer look at the Democratic Party and its new presumptive nominee. But will it get new economic policies? That's what David Weston asked former Treasury Secretary Larry Summers. That's coming up next on Wall Street Week on Bloomberg.
This is Wall Street Week. I'm David Weston. Vice President Harris emerged this week as the likely alternative to former President Trump, focusing investors on what her approach to the economy would be and whether it would differ from that of President Biden. To take us through the choices, we welcome back now our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. Larry, great to have you back with us. What do we know or think we know about what a Kamala Harris administration would do with the economy versus a Donald Trump?
We don't know much yet. The campaign's only been going for 2 days. But I think we've got some strong bases for optimism. First, it's been the Biden-Harris administration, and if you step back, it really has a remarkable record. I don't think any administration has so outperformed the economic forecasts on the day that it came into office as the Biden-Harris administration has, and that's because of an approach that is about investing in America and investing in America's future. And if you look at some of the things Vice President Harris has done, they have that orientation to the future. She knows that our children are our future, and that's why the child care credit and investing in children, investments that reduced the child poverty rate by 1/2 when they were in effect, were so important to her. She knows that fiscal responsibility is central, and that's why she puts emphasis on the fact that we need to raise taxes where it is replacing the ineffective, massive corporate tax cuts that President Trump put into place. She understands that much of our future lies in exporting to the rest of the world. It's not her approach to call Africa and El Salvador countries, as President Trump did. It's her approach to work to strongly support their development, because she knows that more prosperous countries around the world make for a more prosperous United States. It's a new generational approach and a stark contrast with what came before with Donald Trump, and judging by what he's saying on the campaign trail, a even larger contrast with what would come if he were elected. What he describes, David, is a prescription for massive inflation. Ignore the deficit, bash the Fed, trash the dollar, cut back on labor supply by trying immediately to send millions of people home, stop subsidizing clean energy, and put massive tariffs on so businesses can't get cheap inputs. It's hard to imagine a better strategy for creating inflation, for creating high interest rates than the Trump strategy. President Harris, I believe, will avoid all those pro-inflation mistakes, and much more important, will build a future-oriented economy through our kids, through our technologies, through containing our debts, and through working with the world.
So let's talk about those pro-inflation policies, and specifically on the fiscal stimulus side, because you've been outspoken about that in the past, that has contributed to inflation. And investing in children obviously is one thing. She's also has been for expanded Medicare. In fact, at one point she was for Medicare for all. She backed off that a bit. She's also for rental assistance programs. What do you make of those? Are those good ideas? Assuming she could get those through, are those good for the economy?
I don't think it's fair to judge Donald Trump by the things he was saying when he was campaigning for office the first time or even before. And that was a very different context. And I don't think that Vice President Harris feels committed to the things she said during her campaign for the presidency before she joined the Biden administration partnership and advocated those policies for 4 years. No, I don't think Medicare for all is a good idea, and I wouldn't expect that a Harris administration would push Medicare for all.
Larry, next week, you and I will both be out in Aspen for the Aspen Economic Strategy Group meeting. While we're doing that, the Fed will be meeting in Washington. We'll have another Fed decision. We just had Bill Dudley, whom you know well, we all respect, come out just this week in a Bloomberg opinion piece saying it's time for them to cut rates as early as next week, and relying in part on the so-called SOM rule about where unemployment is going. What do you think about that?
On current facts, I would not cut rates next week. I think we need to be very careful about making the move, especially since when the Fed starts to cut rates, there will inevitably be an expectation of some cascade of rate cuts. It's certainly true that as the news has come in over the last several months, it's tended to be on the low inflation and on the soft economy side. And so markets have now adjusted to expect a rate cut in September. I had thought that that was a possibility, but not a probability. On current facts, I'd certainly regard it as a probability, both in terms of what should happen and what will happen. But I think it's the better part of prudence, particularly in so unsettled an environment where the deficit figures are coming in a very problematic way. I think it's the better part of prudence for the Fed to wait a little longer before cutting rates.
As you say, Larry, it's such an unsettled environment right now, and part of that unsettlement is what happens in November, which of these very different economic approaches we have in the White House. Give us a sense, from the Fed's point of view, do they try to take that into account, or they sort of ignore it? Ignoring it seems to be like putting your head in the sand.
I think the Fed needs to consider all the factors in the environment, whether it's the fiscal policy, whether it's business confidence. But obviously, the Fed needs to stay out of politics and not be trying to tilt in either direction. So I'd expect the Fed will be watching the markets, and the markets will be watching all the political uncertainties. And so in those ways, the political uncertainties will factor into the Fed's decision making. But certainly, I don't think the Fed should be explicitly getting involved in politics. I do think that there is an underestimation in the political class generally, but a far more severe underestimation on the Republican side of the fiscal policy risks in the current moment, where the Republicans are talking all about deficit increasing measures, whether it's on the defense spending side or on the tax cutting side, with nothing really pointing towards any kind of control, and at the same time making it harder for the country to sell its debt by trashing the currency. I think they are setting up the United States for a kind of Liz Truss moment. The Democrats are not as focused in this political year on the fiscal challenge as I suspect a new administration may have to be. But at least when fires are burning, they are not throwing gasoline. And that's a very important distinction.
Larry, it's always such a pleasure to have you with us. Thank you so much. That is our special Wall Street Week contributor, Larry Summers of Harvard. Coming up, the view from Goldman Sachs on where this economy is taking investors with Sharmin Mossavar-Rahmani.
U.S. preeminence is intact, and stay invested.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. A stock market that just won't quit, a bond market rewarding fixed income at long last, and inflation apparently coming under control, at least for now. What's an investor to do? As Chief Investment Officer for Goldman Sachs Wealth Management, Sharmin Mossavar-Rahmani answers that question every single day. And we welcome her back now to Wall Street Week. Always a delight to have you here, Sharmin. Thank you for joining us.
Thanks for having me.
Okay, so you talk to investors all the time, customers all the time. What are they asking about? What are they concerned about right now?
They're asking the questions about our two key investment themes. We have been telling clients to be overweight U.S. equities, and we've been telling them to stay invested. So after this big market rally that's been going on for so long, as you pointed out, clients are saying, are those themes still valid? Should we still be overweight U.S. equities, and should we still stay invested after this unexpectedly significant rally following 2023, which was also very strong? And our answer to both of those questions is yes. U.S. preeminence is intact, and stay invested.
So let's break that down. First of all, the equities part, then we'll get to the U.S. part. Equities, we do have real returns now in fixed income. Doesn't that shift the emphasis at least somewhat? Because you can make real money now on bonds.
Well, our view is that the upside in U.S. equities is substantially greater. So when you're looking at the return expectations, we do recommend, especially with U.S. clients, they need to look at the returns on an after-tax basis. So you can't just look at the yield, for example, on Treasury bonds or on corporate bonds and then compare that to the expected return for U.S. equities. You actually need to look at both on an after-tax basis. And one of the most amazing things about U.S. equities are if you have them in some passive tax-efficient form, you have very little bit of a tax liability, and there's much more long-term upside. So we actually recommend clients be at their duration target for their fixed income assets, but still overweight U.S. equities versus non-U.S. equities.
What about the valuation in the equity market? Some people are concerned we're getting a pretty high valuation. So you say there's a lot of upside left in equities. Are we sure about that?
So there's no short-term upside. In fact, the U.S. equity market has exceeded our expectations for this year. So our good case for U.S. equities this year, when we published our initial outlook, was up 13%. And so now we're up about 17% year to date, roughly. And so when we look at that, we'll say, yes, it has exceeded our expectations, but earnings have been better than expected. Typically, when you start having the Fed cut interest rates, as long as we don't go into a recession, on average, U.S. equities are up 19% for the next 12 months. So we may not have much upside left for the rest of this year, but already the market's starting to think about 2025 and what earnings will be. And then as investors shift focus to 2025 and earnings and price targets, that's when you'll see some more upside.
You said something terribly important there. As long as we don't go into a recession. We had Bill Dudley, actually, with an opinion piece in Bloomberg this week, saying he's got some concerns now, growing concerns with a slowing economy, particularly with the SOM rule, that relatively complicated rule about unemployment and when it points to recession, that he says there is now a growing risk of recession and maybe the Fed should cut as early as next week. What do you think about that?
We actually follow Bill Dudley and try to talk to him often and think very highly of his opinion. He went into 2023 expecting a recession and a very high probability. So we've had this discussion with him on the likelihood of recession. We started this year with a probability of 30% for the odds of a recession, and we have stuck with that. And people say, well, why aren't you lower? Some people are substantially lower. We haven't changed our recession probability, partly because of the shape of the yield curve. The yield curve is significantly inverted, or it was more inverted before, and it has stayed that way. And we have what we call a yield curve diffusion index, and when that triggers, more often than not, you get a recession. That's why we're at 30%. However, when we think about these various indicators like the SOM rule that you refer to, we also have to consider and factor in some unusual situations. So people talk about the amount of immigration in the US, and so that has pushed up the unemployment rate. Or post-pandemic, we were at such low unemployment rates that getting slightly above that is not necessarily an indication of a recession around the corner. So do we worry about a recession? Do we need to be on the alert about it, look at other indicators? Yes, but are we worried about a recession anytime in the next 12 months or so? Not at this point. 30% probability. That means 70% probability of no recession.
We also have an election coming up in November, and without regard to who might win or who might lose, there appear to be somewhat different economic approaches of the two candidates. We know it's Donald Trump on the Republican side. We expect that it's going to be Kamala Harris on the Democratic side. Do clients ask about that? Are they concerned about that? Do they invest around the uncertainty with economic policy?
The biggest question our clients are asking when it comes to the election outcome, leaving aside people's political preferences, is what will happen to the fiscal deficit and the debt trajectory of the United States. That's the big concern. And our view is that while people are very concerned about debt to GDP being at 100, we also have to recognize that we got to 100, the dollar didn't tank, interest rates didn't skyrocket, the equity market didn't drop off a cliff. And so even at 100% debt to GDP, investor confidence is that that is a sustainable level. The question is, where is the tipping point? And the reality is nobody knows where the tipping point is. We've asked different people, different economists, people you have on your show on a regular basis, do we actually have any insights? And the reality is we don't. The IMF has done a study where they think debt to GDP in the US is on a level that gives us some fiscal space, is about 180. University of Pennsylvania, Wharton, they've done their own modeling. They're at about, the average is around 180% debt to GDP. So right now we're at 100. So there's definitely some fiscal space. And so will either president winning, and whether we have a Democratic sweep, a Republican sweep, divided government, they'll make some difference at the margin, but not enough to derail our U.S. preeminence theme. And that's what we tell clients.
And so in a nutshell, as you see it right now, that problem, that fiscal problem, is not on the immediate horizon. It may be somewhere out there, but not right now.
Not immediate. We definitely can sustain these levels for a while. Again, because of U.S. preeminence, reserve currency status, incredible earnings per share growth, so portfolio flows, as well as foreign direct investment.
Sharmin, it's always such a pleasure having you on. Thank you so much. That's Sharmin Mossavar-Rahmani of Goldman Sachs. Coming up, what the divergence in economies around the world means for investors with David Hunt, President and CEO of PGIM.
This kind of summer of democracy, which we're still working our way through, is only heightening that as well.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Geopolitical risk remains high, and economies around the world face different paths ahead. To take us through what this means for investors, we welcome back now David Hunt. He's President and CEO of PGIM. Great to have you back.
Oh,
David.
it's wonderful to be back with you, David.
So let's start with the geopolitics, because we have a heightened level of geopolitical risk these days all around the world, pretty much wherever you look. How does that affect investors?
Well, the first thing I would say, David, is that it may be heightened relative to the last 10 or 12 years. but I would not say it's necessarily heightened relative to the longer-term sweep of history. We've actually had a period of real, I would say, moderation since the GFC in terms of political flashpoints. And it's really been the last few years between the health pandemic, 2 wars, that we've started to see these reemerge. And I would say it's more of a getting back to normal than it is actually a heightening of the averages. I would also say that I think that this kind of summer of democracy, which we're still working our way through, is only heightening that as well. So I think we have even more geopolitical risk. And indeed, as I travel the world talking to our large institutional investors, their number one risk is geopolitical. It is not what's the Fed going to do. It's not where are we in the interest rate cycle. They really want to talk about the heightened geopolitical risk and what that does for their portfolio construction.
So talk to me, David, about that very issue, the intersection, if you will, between economic growth and the path forward to long term, because you're a long-term investor.
Right.
How that intersects with the politics and the geopolitics. I mean, how does the politics potentially affect the long-term growth of a Europe, of a Japan, of the United States?
Well, it's really interesting because long-term investors have a very different attitude toward, I think, volatility in general, and that's probably the biggest difference. So I think a lot of the popular media confuse volatility and risk, and they're really not the same thing. So when I say we have heightened volatility, that actually can spell as much opportunity as it does risk. I mean, the only way you lose money is to sell an asset for less than you bought it for or take a permanent impairment. But simply because markets move does not create a loss. And long-term investors tend to look through those cycles, and they use changes in market levels to actually get in at a more attractive price. So as we look forward to the increased volatility, our key focus is, do our clients have enough liquidity so that they can move and move in size when the time is right? And I would say that as people have moved more into privates and more into illiquid assets, that liquidity has become a bit squeezed. And a lot of the work we're doing with clients is to make sure that they have the liquidity so that they can move when the timing is right.
It's one of the things your institutional investors take a look at, your institutional clients, is long-term growth prospects. Because right now it looks like, for example, Europe is different from the United States. Just to take one example.
No, it's a great example. And I would say that we are seeing a pretty big rotation in how people view growth opportunities and where they're putting capital to work. So if you start in Europe, in general, people are quite, I think, pessimistic about growth. The EU is no bigger now than it was in 2018. And it really doesn't seem to be breaking out of the cycle of low productivity and low growth that it's had. Meanwhile, you then go to Asia, and you find, on the one hand, Japan, which is, I would say, in a new, kind of found optimism. They finally have inflation back, which they're grateful for. Growth has come back. They're very constructive about some of the reforms that they've made to corporate governance. And I would say there's more optimism there and about international investors looking in than we've had in a long time. And in fact, I would say that Japan has been the leading country to benefit from the tensions with China, because many people are now building their plants and building their supply lanes around a strategy that's based in Japan. So Japan, I think, is much more positive. China, on the other hand, is probably in a more difficult position. Even last week with the third plenum, we did not see the kind of concerted action that we all thought was going to be needed. So I think people are worried about growth, and they're worried that there isn't going to be a resurgence of consumer spending, which is what's really need to rebalance the economy, but rather continued focus on manufacturing. So there's no new money at the moment going into China. Then you come back to the U.S. And, as difficult, and we like to focus on all the problems of the U.S., actually productivity has looked not bad. Growth is looking, like it's powering through this difficulty. Wages continue to be pretty strong. So, the U.S. is on a relative basis at this point doing very well. So the net of that is that there is really money coming out of Europe. There is no more money going into China. there's quite a bit more money going into the U.S. and Japan, and then select emerging markets like I would say Mexico, Vietnam, Indonesia, which are benefiting from the changes in the global supply chain. So it's a very differencing shift in how people are putting their money to work geographically.
Let's pick up on one thing that you just referred to, which I find puzzling, because here in the United States, maybe in part because of the election, not entirely, we tend to be very critical of what's going on economically. We're in a lot of trouble, a lot of uncertainty and things. And yet the rest of the world seems to want to invest here. The inflows are remarkable here. By the way, a lot of people want to come here. It's one of the reasons we have an immigration problem is everybody wants to move here. Who's got it wrong? I mean, are we misperceiving our own economy, or is the rest of the world overestimating what we can do?
I think it may be a little bit of both and maybe a third as well. I think that there's no question that the corporate sector, and therefore what's driving earnings and therefore kind of the markets, is in better health than almost any of us would have predicted 18 months ago. That doesn't necessarily mean that consumer sentiment or the average person is feeling that way. And for them, they're much more likely to feel actually the world's 20% more expensive than it was 3 years ago, and my wages haven't gone up by 20%. So for the median worker, you don't feel that things are quite so great here. So both of those stories, I think, are equally true. But what we do have, I think, is a very dynamic economy. And if the pandemic told us anything, it was, we were chaotic. Every state did it differently. We couldn't enforce rules, all of the things that we don't like about ourselves. And yet we came out of it, I think, pretty strongly, pretty quickly. And our corporate sector was able to actually rebalance with a lot of help from the government, obviously, very quickly. And I'd say that our rebound is a real sign of strength of the fundamentals of the U.S. economy.
Historically, the downside, if there is one, to some of the alternative investments is you give some liquidity. You freeze it up. Mm-hmm. So in this world, when you're getting real yield out of bonds, why are people willing to give up some liquidity actually in alternatives? And for example, is PGIM backing off alternatives right now? So
no, we actually, we have about $300 billion in alternatives assets under management. So it's about a quarter of our total assets, and probably one of the fastest growing areas of the market. And for us, it's mostly about private credit and also about real estate rather than private equity. And those we actually think are going to be very good growth engines going forward. Private credit is undergoing, I think, a real sea change. Since the GFC, banks have continued to back out of lending money into the middle market. And so private investors and asset managers like PGIM have really stepped into that void. I don't see that reversing. I think that this asset class is going to continue to grow, and it's going to go from direct lending, which has been into the middle market, to now asset-based finance. So these were all on banks' balance sheets. It's project finance, infrastructure, rail car leasing, aircrafts, and all of these which historically were not done through the private credit ecosystem. Now they are. So that is really, I think, a fundamental shift in the way the economy is being funded, and it creates real opportunities for asset managers like PGIM.
David, it's such a treat always to have you on. Thank you so much. That is David Hunt of PGIM. Coming up, the path forward for commercial real estate with Owen Thomas, Chairman and CEO of BXP.
All CEOs, in my opinion, want their employees to be working in person more. And one of those carrots is to be in a great building.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Commercial real estate has been among the slowest to recover from the pandemic. We talked to BXP Chairman and CEO Owen Thomas about the path forward for the space.
It has been a rough time. I always say, though, perception is worse than reality. And commercial real estate is bouncing back, defined as office. There are two external drivers that really drive the office business, certainly the business of BXP. One is interest rates, and the other is corporate earnings growth. I think the interest rate story is pretty obvious. Real estate stocks, real estate are primarily a financial asset, and if the cost of capital is lower, those assets are worth more. we had a very favorable inflation report last week, and since that came out, and with the prospect of more rate cuts and the fact that the 10-year now is below 4.2%, it's really escalated our stock price over the last week. The second important driver is corporate earnings growth, because that drives leasing. In 2023, the S&P 500 earnings growth was flat, 0. In 2022, it was very tepid. But here in 2024, in the first quarter, it was up 8%, and this quarter is predicted to be even higher. So when companies are profitable and they're making money and they're growing their earnings, they're more likely to grow, hire people, and take more space. And we're seeing that in our leasing activity. In the first quarter at BXP, the square footage that we leased was up 30% from the first quarter of 23. And in the second quarter, we're seeing continued escalation, both in terms of signed leases and our pipeline for future quarters.
Up 30%, but is that off of a low base?
It was off a low base, yeah, because we went through, as interest rates went up in 2022 and 2023, as I mentioned, corporate earnings growth slowed way down. And when that happens, companies aren't growing. They're thinking about ways to cut costs. And we saw that. A lot of sublease space got put in the market. There wasn't a lot of new requirements in the market. But now that the environment around corporate earnings is improving, it's improving our leasing because companies are growing again.
So strong corporate earnings make it a little easier to hire more people, as you say.
Yes.
You have to actually get the people into the office.
Yes, that's true too. That's true too.
How's that going? How's return to office going?
Yeah, I do think there's no question that work from home has an impact on office demand. I do think in the premium sector where we operate, it's a little bit less so because the clients that we have generally want their employees to be in the office many days per week. But in terms of what we actually see, BXP manages today about 54 million square feet, and we have badge data on about 50% of that space. And so what we're seeing today versus the last quarter before the pandemic is in New York, Tuesday to Thursday, on buildings that are comparably leased, the visitation is the same. So in other words, the badge swipes haven't diminished at all. So Tuesday to Thursday, New York is back. And Monday is coming up slowly, and Friday's very slow. I mean, by the way, Friday was slowing down before the pandemic, but it's definitely slower today. So that number in Boston is about 80%, also rising. So Boston is also improving Tuesday to Thursday. And then San Francisco lags. It's at 52%, but again, that is slowly improving. And the other thing that we see in the data is that if you look at the unique weekly visits of a worker, that gap between the East and the West Coast is less. However, those individuals are coming into the office fewer days per week on the West Coast than they are in New York or Boston.
When it comes to the stock market, it's been driven so much this year by that so-called Magnificent Seven, which seems to be a lot of it related to artificial intelligence.
Yes.
Is that spilling over into the commercial real estate market?
It is. It is. So if you look overall in space demand today, I actually would say the technology companies is the biggest gap. We see most of the demand today coming from financial services companies, law firms, professional service firms, and the technology companies are not leasing space at nearly the level that they were before during the pandemic, primarily driven by the large tech companies. However, in San Francisco, to your point, David, there are a number of AI companies, small startups and medium-sized companies that are taking space. I think the net absorption from those companies over the last year or 18 months has been about 2 to 3 million square feet. And also, interestingly, those workers are in the office, I think in many cases up to 5 days a week.
So when you get a new project, the 341 Madison or otherwise, is the financing there for it?
Yes. So great question. So on the financing, I think you have to divide it between the private market and mortgage financing that's secured by the properties and also the public unsecured market. So on the private side on mortgages, it's challenging. There are many banks, insurance companies, other lenders that are not getting repayments of their office loans, and therefore they don't have fresh capital to lend on new office projects. It's very hard to get. We did a very large secured mortgage financing last year on a ironclad building in East Cambridge, and we didn't get a quote from a U.S. lender. We ended up closing the deal with European and Asian lenders. So that's on the private secured side. But if you look at the unsecured market, there are a handful, there are many REITs that are investment grade or not investment grade rated, and they're funding themselves in the public investment grade bond market, which is what we do. And so we have access to that market. In fact, our spreads are at long-term averages. So we're not being per se penalized for being an office company in that market. The overall cost of the financing is a lot higher than it used to be, just because the 10-year Treasury rate is much higher than it was 2 or 3 years ago.
Go back to your Cambridge building for a second. No domestic bidders for it.
None.
So it came from overseas.
Yes.
Is that a larger trend? I mean, because the United States in general is an investment haven right now. You're seeing a lot of foreign direct investment coming in. Does that apply to commercial real estate?
I think so. I think that there are buildings that are selling, office buildings, today. I think primarily they are distressed types of deals, and the buyers tend to be family offices and distressed asset funds. And my guess is the underlying capital for those is a mix of both domestic and non-U.S. sources. But broadening that out, there also are large international sophisticated investors that want to continue to invest in U.S. real estate. We announced last year a major joint venture with Norges of the Norwegian Central Bank, and they invested $750 million in 2 life science developments that we are completing in East Cambridge, and that was obviously a very significant commitment.
Since we started really talking a lot about commercial real estate, there's a lot of emphasis on the premium buildings. You're in premium, but there's an A and a B and a C and things like that. Is that difference maintaining? Is it exacerbating? Is it diminishing, the distinction?
Yeah, it's certainly maintaining and maybe even escalating further. So the way we describe it is there's premier workplaces and there's everything else. And the premier workplaces we're defining as basically the top 10% of buildings in our market. Those buildings tend to be a little bit larger, so it's about 15 to 20% of the space. What is the definition of a premier workplace? Well, it's a building where if you have an industry-leading client, they would be interested in leasing space in the building if it was available. So it's that top 10%. And if you look at the data for those buildings, first of all, the asking rent for that 10% is 54% higher today than the other 90%. And the vacancy, the direct vacancy rate, is about 7.5 percentage points. It's about low 11%, which is 7 percentage points lower than the rest of the market, which is at like 17 or 18. And then lastly, the net absorption. If you look at it for the 5 central business districts where we operate, the net absorption of space into that top 10% has been a positive 8+ million square feet. And for everything else, it's been negative over 30 million square feet. So you've got, last couple of years you had companies shrinking, but you also had migration from the B and C buildings into the premier workplaces. Why is that going on? Well, I think a couple reasons. One, all CEOs, in my opinion, want their employees to be working in person more. And one of the ways that they're trying to make that happen is through carrots, not sticks. And one of those carrots is to be in a great building. And a great building is one that's has access to transit, has great views, light and air, has great amenities, meeting space, all those types of things. So we see, and we have had clients that have elevated their rental costs because they want to be in a better building. That's a key driver. And then I think the other thing that's going on is the workforce is becoming a little bit bifurcated. So the workers that are product-facing, client-facing, that need to collaborate, they're all working in person. But a lot of support areas like IT, accounting, HR, a lot of companies, by the way, including BXP, has more liberal remote work policies for that workforce. So they're coming into the office less. And if you look at the overall office market, those workers tend to be more in the B and C buildings as opposed to the premier workplaces. So I think those two trends are what's driving this divergence between premier workplaces and the rest of the market.
Coming up, forget about the movie or the car or even the presidential race. It's the merch that counts. That's next on Wall Street Week on Bloomberg. finally, one more thought. Mel Brooks taught us that it is in merchandising that the real money from the movie is made. This week, a lot of people in Paris are hoping that there will be real money to be made from selling Olympics merchandise, which 4 years ago in Tokyo brought in over $127 million for that Olympics. And they'll need every penny of that to help cover the Paris operating budget of over $4.3 billion. If Paris wants to get some real money for merchandising, maybe they should get a celebrity or two involved, like George Clooney, who, with a friend, put together a tequila brand he sold after 4 years for $1 billion.
Everything about Casamigos is real. There's nothing made up. George and I signed, every batch we'll sign because we want to make sure that it's exactly what it's supposed to be.
Then there's the new Louis Vuitton Timberland boots going for a mere $2,850 for the pair. Master marketer Elon Musk appears to be raking in plenty of real money from a wide range of merchandise, including everything from spacesuit onesies for infants with SpaceX logos on the sleeve to a men's fragrance named Burnt Hair, described as, quote, the essence of repugnant desire, to a Cybertruck-inspired cat bed. And now, for all of those wanting to try their own hand at making some real money from merchandising, the way George Clooney and Elon Musk have, you can go to Harvard to learn how. For a mere $12,000, you can take Professor Anita Elberse's 4-day course, that's the business of entertainment, media, and sports, and study everything from David Beckham's brand management to how Beyoncé launches her new albums. But you'll have to get in line behind executives from Hollywood and Madison Avenue, as well as Channing Tatum and LL Cool J. It's a safe bet, however, that one person who will not be needing any fancy Harvard course is the marketer-in-chief. He is, of course, the former President of the United States, Donald J. Trump, whose red MAGA hats and other clothing have become ubiquitous. According to website Chummy Tees, online searches for the former president's T-shirt spiked by over 7,000% after that attempt on his life in Pennsylvania. That is the largest spike in searches and clicks to our website we've ever seen, they say. And if that weren't enough, Axios reports that a Trump-owned company was out with limited edition sneakers that include on the shoes a picture of Mr. Trump right after the shooting with blood on his face. And for your $299, you'll get not only the sneakers, but a chance to get one of 10 pairs that will be autographed by the former president and given out at random. So, Vice President Harris is now in a fierce contest, not only for votes, but to win the merchandise competition. She's playing from behind, but her supporters had unofficial T-shirts and water bottles online within minutes of President Biden's announcement last Sunday. And it took her new campaign only 12 hours to get the real merch out there. But to make sure she comes out on top, she might want to take another look at the greatest movie about merchandising of all time.
We've been down this aisle already.
We've never been down this aisle. It's paint.
Back it up, back it up.
I'm tour guide Barbie.
I'm a married spud.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.